Pat McClain is the co-founder and senior partner at Allworth Financial. He's a keynote speaker at financial conferences nationwide. For more than 2 decades, he's co-hosted Allworth's Money Matters, one of the longest-running financial topic radio programs and podcasts in the country. Pat has led Allworth to be ranked 23 on the Barron's list of top RIAs in America and has been recently named one of 10 icons and innovators by Investment News for 2021. Over the past several years, Pat and his business partner, Scott Hansen, have introduced Allworth to numerous new markets and have expanded the company's service offerings to include tax planning and accounting. Through a combination of both organic expansion and growth via acquisition under Pat's direction, Allworth Financial has now grown to over $15 billion in assets under administration. Pat, welcome to the DealQuest podcast.
Well, thanks for having me, Corey.
So listen, this is a very interesting time. And the reason why I wanted to do this special series on aggregators and integrators is because, we've come to a place where, we've never been in this independent RA space in terms of the number of deals, the amount of money in the space, the valuations and all that kind of stuff. And, we represent a lot of sellers in the space. And frankly, the great news is there are many more options. And the challenging news is that they're trying to figure out what's the difference between, all the options out there, the different models, what is the best fit for them. So, I'm excited to have you on for you to be able to talk about Allworth's particular model and approach and unique, value proposition out to these advisors so they can understand what you're offering. So before we get to that specifically, though, I want to take you back to when you were a little kid growing up, maybe 8, 10, 12 years old. What did you want to be? Because I'm sure being the co-founder and leader of a RIA firm, an aggregator, probably wasn't it back then, but you tell me.
Oh my gosh, what did I want to be when I was 8 and 10? Not picked on. Let's start with that. I grew up in a big Irish family.
Okay.
So we'll go with that. I knew I wanted to be in business of some sort, and I knew I didn't want to be poor. So there's not a lot more than that. And we didn't grow up poor, but we certainly didn't grow up upper middle class either. So I came from a family of 5 kids, and when we were little, my dad was a salesman and we sold at the swap meets or flea markets or whatever you call it. My dad would go out and buy all the pictures in hotels that were being remodeled, and we would take it out to a swap meet or flea market at the 2nd and 3rd grade. I still remember walking around selling these pictures for $2 each, of which you would get 25 cents from, which is actually not bad as a percentage. You're getting a 12.5% commission on these pictures. So, we all start somewhere, right?
I love it. It sounds like we had very similar backgrounds in that. Yeah, I always say that, we weren't poor. We always had food on the table, but, it was lower middle class. Like we also didn't take vacations or eat out or do any of that kind of stuff. So
Yeah. No, we ate out twice a year.
Twice a year. There you go.
There
All
we
right.
go.
And one other question looking back before we get into what you're doing now and all the great things Allworth's doing. What was your first deal of any type that you can remember? It could be something small when you were a kid or something early in your career, whatever comes to mind.
Oh, first deal. Yeah, when we were at the flea markets, I was in the 4th grade. And when we'd walk around selling the pictures, we would buy bicycle parts and any other thing early in the morning that we thought we could sell later in the day. And I remember buying a mini bike for $15, and my brothers and I were so excited about it. And we brought it back to where you had to stand at the flea market. And by the end of the day, the mini bike was gone. My dad had sold it for $35, right? Probably for 2 reasons. One is he didn't want us to have a mini bike, which was probably good thinking. And the other is that there was some money to be made. And then he split the profits with us.
I love it.
He took 10 and my brothers and I took 10. So I was in one half. Let's say I was on the buy side of that deal.
Right? It sounds like in maybe a non-consenting or unwilling business partnership with your father as well, right?
That's all right. Yeah. And when I was in junior high, I ran, they have these flea markets and swap meets, and I ran a cactus stand out there for 2 years. I worked for a guy for 6 months, and he went on vacation and never came back. And I bought his inventory from him and ran the cactus stand. I knew I didn't want to work in a flea market the rest of my life. Let's just go with that.
I love it. I love the entrepreneurial backstories of successful people because it's always fascinating. All right, so let's talk a little bit about Allworth's trajectory. And obviously the industry has evolved where there's so many more deals and so much more money in the space, right? equity capital, debt capital, that kind of stuff. Now, talk to us a little bit about, you've had significant growth, especially in the last number of years. And so talk a little bit about the shift from just the organic growth to doing a lot more inorganic, who your capital partners are and what kind, and the deal flow you've been doing over the last number of years.
So I'll start at the beginning. Scott Hansen and I met. We worked at a life insurance company together 30 years ago. His cubicle was next to mine, and we worked there for a couple of years and decided we were going to go out on our own. So we leased some space from an accountant and bought some furniture and a couple computers. And I had $10,000 in an IRA I rolled out for 60 days for the capital to start the business. And I remember our stated goal was to get $100 million under management. I said, I told my wife, we get 100 million, we're set. We are set, right? That's a bad month now. And we built it. And then early on, we started with this a salaried advisor model, which is rather than make people partner, they would work on a salary and we would generate the appointments for them. So I had a call center back in the day, still do. And we would do outreach marketing, radio, television. I've been doing this. You mentioned the podcast and radio show for 27 years. So that's kind of where it grew and we grew and we grew. And when we were I think we were probably 22 years into it. And I've had a couple other ventures in the meantime. I had a company where we taught investment advisors how to market to telecom communication workers, where we pulled about $5.5 billion into those offices, and I just got paid a percentage. It never landed on my platform. I started and sold the largest reverse mortgage company in the U.S. Scott Hansen and I did with Pete Engelken, who's my chief operating officer. So I'd been doing a couple things on the side, but the whole time running at the time Hansen McClain. So 7 or 8 years ago, we got to about $2.4 billion. We had 3 offices in Sacramento. We had opened an office in Walnut Creek, California, and one in Denver, just to see if we could take this thesis we had about growing the business and go into markets that we weren't in and starting from scratch. And it worked. And we got to about $2.4 billion. And we're approached, like many of the people listening to your podcast now, approached by many, many, many firms on a continual basis. And we met with a couple of them. And we said, no, we're not going to do this. And then we came to the realization that we couldn't grow. My risk tolerance had pretty much hit its limit. As did Scott Hansen's, which when I say hit its limit, more money would not have necessarily made my life better, but less money would have. And I had already had a capital event with the sale of the reverse mortgage. So, retirement was pretty stable, but, it's really important for me to stay engaged, probably more important for my family that I stay engaged. It's someone other than them continually, right? Just somewhere to get out of the house and do something productive. And so we bumped into Parthenon, which was a firm that had been talking to us, and we did a deal. And quite frankly, it was probably one of the best decisions I had ever made. They were great capital partners, still respect them today. We still talk to Parthenon, great capital partners, good people. And they brought a level of sophistication to our business that was beyond what we were doing, not beyond what we were capable of, just beyond. They made us think about us being bigger than ourselves. And in less than 4 years, we went from $2.4 billion to $10 billion under management. We hit our 5-year stretch goal in about 3.5 years. And then we traded again to a new capital partner, which is Lightyear Ontario Teachers Pension Plan. Great capital partners. They both have different styles, but both of them added great value to the business. Probably the biggest thing is I quit running my business for cash flow and started running it for value, for long-term capital appreciation, and then added more services that you can't when you're small. Even at $1 billion and $2 billion, we didn't have tax. So now we bought a tax practice and integrated that. So we either discount or give away tax for free to clients. We have an integrated services where we actually have an insurance desk, if you will. So if any of our 110 advisors has questions about insurance, they don't have to go out looking. It just turns over in-house. We have integrated estate planning, hired an estate planning attorney to review wills and trusts. We added 55 IP for tax loss harvesting, direct indexing, SMAs. Just the menu of our investment options is expanded probably by tenfold. And then the sophistication with software. hiring a really high quality CTO and a chief financial officer and chief legal officer, which quite frankly, every small firm would like. You have to get to scale in order to make it work.
Sure,
Um,
sure. So since you brought in the capital partners, give us an idea of how much, like the deal volume that you've done over the last number of years, and on the M&A side.
So I think we've done. Don't quote me on this. I think we've done 23 or 24 deals since we took capital, which was probably a little bit over 5 years ago. But
Mhm.
I didn't build out my M&A team to scale until the last 18 months. So it was myself and one other person that were doing that prior to this last capitalization with Lightyear in Ontario. And now I've got 6 people on my team and 7 people on the finance team that help me. And then I have an integration team to integrate these firms that we call mergers and partnerships, not mergers and acquisitions. And the
Yep.
reason is there's an awful lot of equity that normally gets rolled over. And we are looking for like-minded people, how they feel about financial planning is being the backbone of our offering, tax, estate planning, and obviously asset management.
So that's a perfect segue. So let's talk about what your model is. So you mentioned equity, right? Obviously we don't need anything confidential on any particular deals, but in general, what is the model? Who are you looking at? So let's at a high level, you hear this distinction between aggregator and integrator, and it's a little artificial, right? Some elements of both, but where on that spectrum are you? What's the model? Some cash, some equity. Who are you looking to attract? Give us that.
We're there are aggregators and integrators, and we have a piece. If you go to a shameless promotion, Allworth Financial Partners, we
Yep.
have a piece that actually gives the breakdown, the difference between what a real integrator is and what a real aggregator is. We are a integrator. There we go. Easy for me to say. The whole business is shifted onto a common platform.
Yep.
And the reason for that is twofold. One, it's to free up time for the partners and advisors to do what they really like to do, which is, more normally go out and generate business or meet clients. The other is it brings tremendous amounts of efficiencies through technology and process. So when you're a small business, and I've been a small business, like every firm I've talked to, I think I might have a unique perspective from this being this co-CEO of a $15 billion firm, having started out like many of the firms that we integrate with. I wasn't I didn't come from a custodian, not to say there's anything wrong with it, but I remember what it was like to have 50 million or 500 million or $1 billion under management. I remember what the staffing issues were like and
Right.
technology. And so the idea behind this is that if we integrate all of this, then what we're going to do is bring mass efficiencies to the organization. And small businesses have a tendency to throw people at problems.
Yep.
And businesses that get to scale have a tendency to throw people, process, and technology at problems.
Right.
That's why there's efficiency. That's why it's happened. By the way, this has happened in. Let's go through the industries. It's happened in waste collection, right? So a good friend of mine owns Waste Connections, and they've rolled up 3,000 firms, right? It's happened in health foods with Whole Foods, which was a roll up.
Yep.
And the last big one they bought was, anyway, it'll come to me in about 5 minutes. So these are all roll-ups that have been, it's happened in property and casualty for years and years, both on the commercial and residential side. What makes it difficult for financial services is the models are so different.
Yep.
for every firm. So some are, we only work with these types of clients. We only do individual stocks, and others are, we only work with, this client, and we only do this portfolio. And we've built a platform that will actually allow for all of that. So mid-market, upper market, right? It doesn't, I use the analogy of the Marriott Corporation.
Yep.
Right. So sometimes, well, I'll tell you the story. I was in New Orleans with my wife, and we had gone there for the weekend. I love history. New Orleans has great history.
Sure.
And we were staying at a Ritz-Carlton. We went to dinner one night, and we were walking back to the hotel, and we came up to the building, and it was the building, and it said Courtyard by Marriott on the side. And I said to my wife, I know this is the building. We walked around the second side of the building, and there was a Marriott entrance. I walked around the third side of the building and there was a Ritz-Carlton
Well,
entrance.
yep.
And you're like, okay, this is, I said to my wife, she didn't know what it was. She's like, what? I'm like, this is brilliant. I mean, they get all the efficiencies out of the plant and operations, 3 price points with a similar but not identical product. I'm like, this is a firm I want to build. I want to be able to serve the 10 to $15 million account. And I want to be able to serve the, million to 5 million and below that. And by the way, having smaller account balances allows you to actually grow your own financial advisors.
Mm.
Right.
Yeah, and listen, and that's such an issue in this industry, right? Is that gap in the younger advisors, because most of the firms that are not of your size, and even frankly some of the larger firms, right? I mean, the lack of training, the lack of ability, lack of people coming in, which has always kind of shocked me. I'm sort of half jealous as a lawyer. I'm looking, wait a second. We're both in service businesses. We both deal with sophisticated, great clients, but you guys have recurring revenue, quarterly, paid up front, pulled out automatically from the accounts. Like, what a business model, right?
Yeah.
And you really get to help people. So it's always sort of shocked me how poorly generally the industry has done about bringing up and training and getting new folks to a new blood into the industry.
Well, there's a reason behind that. All right. And the reason is the hardest part of being a financial planner, investment advisor is actually getting the right person to come or to reach out to your firm to engage you.
Yeah.
And so the best sales guys or marketers may not be the best financial advisors, and the best financial advisors may not be the best marketers. So we've taken that and we've split them in two, where I actually have 26 people in my marketing department, and I have a call center that schedules the appointments for our advisors. Now, some advisors will go out and get their own, and they are compensated for that differently than that are set by. But think about this. How many retail offices does Charles Schwab and Fidelity have in the United States? Right?
A lot, right?
I mean, a lot. And do you think any of those people are actually out there getting their own clients, or is Fidelity and Charles Schwab actually, using their marketing muscle and their brand in order to get qualified people in front of advisors? Right. And is Schwab any better than my firm, or let's say a Mercer or a WAG or Fidelity any better than any of the others? I would say no. In fact, I would say that there's many reasons that you should be wanting to use an independent advisor. No disrespect to Schwab or Fidelity, because they have figured it out.
Yep.
There is no question. So not only are we proud of our asset management, but our financial planning, but the machine that generates the interest from people that are potential clients is really, really important. So I can bring an advisor that doesn't know how to or want to go out and generate their own business, right? And I schedule their appointments for them, which is how you actually can build a long-term sustainable company, because you're not reliant on individual personalities to go to the golf course or to the church function or the Rotary or wherever in order to generate that business.
Yeah, no, that's great. So let's talk a little bit about, so you've got a let's say an independent firm of whatever size, or and you can tell me, I don't know if you do also doing IBD teams or anybody out of wirehouses, but whoever it may be, who are you focusing on, and then what general are the components of the deal? You mentioned obviously equity. I'm sure there's some cash. So talk to us, what it looks like.
So in today's environment, and these are different than how you were pricing deals, 6 months or even even 6 months ago, most certainly a year ago. We do take teams out of the IBDs, the independent broker dealers that operate under someone's corporate RIA. And I do own a broker dealer. Unfortunately, I own a broker dealer, and it's not to add assets to that broker dealer other than the firms that partner with us. Yeah. So if you go to an IBD and pull out an IAR, an independent advisor representative out of an IBD, you are most certainly going to find some broker dealer business that pays trail there.
Right.
And so we want to give full value for that. And by the way, We respect the advisors that want to keep those clients because they made a promise to the client to take care of them. We will pull those out. We pull out pure RIAs. We haven't done any wirehouse yet, mostly because how you price them is on the assets that come over, and there's a lot of risk there. I have consulted with many firms that were at wirehouses, and I said, you're probably not ready to sell to a roll-up firm yet. You might want to make this intermediate step to become independent first and then do it. The story actually probably plays better, and it's probably better for the advisor and the client. And then we do the deals, right now we're doing them based on revenue, and it's based on revenue either 24 or 36 months out. The reason for that is it allows them to get value for anything in their pipeline. It allows them to hopefully have time for the markets to recover.
Yep.
Which is, many people are saying, well, I don't want to do a deal right now because, my revenue's down, my EBITDA is down. The worst thing about our business is, the EBITDA is, if your EBITDA drops by 25, if your revenue drops by 25%, your EBITDA drops by, 30, 40, 50%.
That's right.
Depending upon the margins you're working on. And so we're pricing them that way so that there's a stock component anywhere from 20 to as much as 35%, depending upon how we feel about that particular team.
Okay.
And whether the advisors plan on staying around and helping us grow, right? If you want to stay for the next 10 years and become part of the story, we want you to participate in as much equity as we can allow. And then we'll typically put anywhere between 30 to 35% on the back end at either 18, 36 months or somewhere in between the two of those.
Great. So you mentioned a number of the aspects of your value proposition to these advisors, right? Whether it's the integration, the technology, the different expansion of the offerings. You have the ability for you to generate business for some of, especially the newer, smaller guys. You mentioned a bunch of it. Is there anything else you want to mention about the value proposition to these advisors? Because as you know, there's a lot of people going after them. So why else would they consider Allworth?
So part of it is our growth. Our growth has been, and everyone in our industry talks about AUM this, AUM that. Great. Where I shop, they don't take AUM; they only take money. And so when you look at the business, forget it's an investment advisory business. You wouldn't compare, two businesses to each other just based on their sales. If I was going to, throw my lot in with them, I'd want to look at the revenues per versus the AUM and the profitability and the growth and profitability and the cap rate, the capitalization of the company itself. So that's one. And the other is, I didn't mention, we have an analytics and insight team that actually is highly robust, which means all the data that we collect in the information, we put in a data warehouse and then we mine it for insights. And by that, let's say I'm going to run a radio campaign. I will know what the cost of the campaign is. I will know what leads came from the campaign. I will know how long they actually lived in the funnel. I will know per dollar of AUM what that dollar, how much it cost me per dollar of AUM. And then the idea is that you A/B test this stuff constantly in order to gain insights and become much more efficient at it. And then once you do that, you want everything to be repeatable, measurable, and scalable. Can I repeat the activity? Can I measure my inputs and outputs? And can I scale it in multiple locations all at the same time? What's happening in our industry right now, Corey, is just blowing my mind. Marketing firms that are engaging small investment advisor firms and just blowing through so much money. On my feeds, either Facebook or newspapers, I'm getting ads. I'm in Sacramento, California. I continually am bombarded by this poor guy in Columbus, Ohio, that thinks I'm going to be a perfect client for him, right? And I want to just call him and say, fire your marketing company.
Right.
They're showing you numbers about leads and who opened this stuff, but that doesn't necessarily translate into revenues or profitability. And I see this continually. Look, I don't care how you feel about Ken Fisher or anyone feels about Ken Fisher. Don't discount that their ability to market what they're doing, and that they are crystal clear of who they want as a client and how they're going to get there and their offering.
No question. And listen, despite some challenging things that came up for him, there was a bump in the road, and they've grown significantly since then. So that's proof of exactly what you're saying. Again, whatever judgment you may or may not have, the point is that marketing works.
Yeah. You may not like the messenger, but don't confuse it with the message. So it does work, and it allows an organization to actually take interns. Like you point to a half dozen interns from college that then became paraplanners, that became associate advisors, that then became advisors over a relatively short period of time, because we fostered their growth in the organization. And quite frankly, the business that we're in today, most advisors my age, I turned 60 this year, whether we want to talk about it or not, our clients subsidize the growth of our business through the compensation programs that used to be used 30 years ago.
Yeah.
Right? We can pretend that we didn't get paid upfront commissions, but we did. And that was the way it was, right? That was the way it was. Can you imagine opening up today, like where Scott Hansen and I took 10 grand and opened up a business? If you run this fee-based RIA model at 1%, we wouldn't have lasted 6 months.
Right.
Right. We can pretend it didn't happen. And the clients knew it too, because there were no alternatives.
So let's apply this. You talk about the ability to market and grow and support. Let's one of the things that comes up for some firms that are selling, whether it's, certainly people are at different stages of their career, right? Somebody who wants to come in and is in a mode of looking for a succession solution is one thing. Younger advisors who have more runway are one thing, and then we have this classic issue of having the the founders in G2, right, where they're in the same firm, they have different interests. Somebody maybe have a much shorter time frame and a desire to just mainly cash out. Obviously, hopefully most of them, as we know in this industry, do want to make sure their clients and employees are taken care of and they have good intentions. But in terms of their ongoing, they may have a year or two or whatever, and then they're phasing out. Whereas G2 is looking at this and saying, wait a second, I have clients right now is exactly in that situation. The G2 is saying, well, are we selling too early? Right? We know senior guy is pretty much ready to be done, but can we grow on our own more quickly than if we, are we leaving money on the table because we're selling at an earlier stage? So, it's logical that everything you just talked about helps answer that question, but why don't you just specifically apply it to that conversation of the value proposition out to these firms that might have younger folks or G2,
So first of all, let's go with this premise. No business owner / entrepreneur ever said, hey, sign me up for a corporate job and give me a infrastructure that I need to report into.
Right.
It has never been said. So with that in mind, our job is that when we integrate a firm is to find out actually what people's motivations are. So a perfect example, we integrated a firm in Walnut Creek, and this gentleman, great advisor, said, look, I just want to go out and generate business and work through the first couple of years with the client. And then I want someone else to, the ongoing relationship. And by the way, clients are fine with that. I think oftentimes advisors overestimate their appeal to clients. So clients or other ones where, I did one here locally where he wanted to leave the business. And I said, just, give it a year and a half. I said, I don't think you want to leave the business. I think you want to leave parts of the business. And so why don't we actually not make a decision as to when you're going to leave? Why don't you get to see if you actually like what you're doing, since you don't have to run a business anymore? And he's happy as could be. He interacts with his clients. He sits in a little standalone office with a couple other advisors in it. He's happy. He's not leaving the business. But G2, you have to determine what they want as well. And oftentimes when we roll over equity, it's not split between all of them equally.
Right.
So G2 might take a larger chunk than G1, and sometimes, G1, they just want to be the elder statesman or stateswoman and just kind of hang around, and that's fine for a period of time.
Got it. Great. So let's get a little more macro now. We have some interesting factors in this industry. You alluded to before, talking about a little bit of the evolution, the maturation, and having experience like I do in other industries where there's been maturity and roll-ups and, and aggregation and whatever. And at the same time, so, I'll give my hand away a little bit. I think the long-term trends continue to be in favor of, many, many more deals. And certainly we see the breakaway flow of new advisors coming independent continue to be strong. So there's, even as there's consolidation on one end, we have new blood coming in. And at the same time, at least in the short term, there are some potentially worrying trends, things people are focusing on, whether it's the markets being, last couple of days, I think when we're recording this, we're okay. But, the markets being down, inflation, being up, all of these things, war in Ukraine, blah, blah, blah. And, the big R word that everybody is talking about, which I always am worried about this self-fulfilling prophecy, kind of thing. So I don't like to play into that, but there are some headwinds. So, what do you see on a more macro level for a firm like yours and some of your competitors who, the deal volumes have been crazy? And how do you see some of these, at least immediate potential headwinds affecting?
And so back to an earlier comment I made, Whole Foods, the last big purchase they made was Wild Oats, by the way. And then that's when they started growing organically. So it was inorganic. So what we're seeing is that's taking place in our industry as well, where you're seeing bigger and bigger companies actually start pushing themselves together. And then you're seeing firms like us that, the biggest one we've done was $2.8 billion integration AUM, and I could get into the profits at some point in time. And the smallest one I've done is 100 million, which is a guy I've known for 30 years.
Right.
So, what's surprising in this marketplace is I thought some SPACs would try to take out different firms, and there was some hints at it, but most of them look like that they never actually came to fruition.
Yep.
And we're now starting to see some larger firms come together. I don't think that we're going to see a big publicly traded large firm anytime soon. What I suspect is that this will probably run in the private markets for 8, 10, 12 more years.
Yep.
And that we will see some integration of larger firms. But at the end of the day, the big blowout will be 2 or 3 large, when I say large, it'll be 40, $50 billion firms pushing themselves together for a national footprint. I think that's where we're going to end. And then you'll see a couple more of those. There'll be, large regional players and a few nationals. There are headwinds, right? The cost of money has gone up, and don't pretend that firms that are aggregate and integrate don't use leverage. Absolutely do use leverage, and that the earnings are down. The EBITDA is down for many companies, as we talked about earlier, which actually makes access to debt either more expensive or less available, which I would expect will start to slow some of these deals. But the capital backers are willing to throw in a lot more money, a lot more money. You're seeing, I just read another one today where a broker dealer, just took private equity to actually create their own integration machine. I think a lot of that happening on the broker dealer side is to actually stop their IARs from actually leaving their platform. So they're trying to figure out, how do I give fair market value to the IARs while at the same time getting an arbitrage move, playing off their balance sheet, but using some outside capital as well. I expect that we'll continue to see that. I don't know how that helps a lot of the independent advisor representatives that are broker dealers, because many of them aren't happy with their broker dealers today. I shouldn't say all, but many of them. So I don't know if that answered your question. So the macro is, I think that the deal flow is actually going to continue. I think that there's some buyers in the marketplace that are buying that don't quite understand the business as well as they should, and that there will be some blow-ups here in the next few years with firms that were either paid too much for or poorly run. I'm starting to see small firms push themselves together for no other reason. You're shaking your head, Corey, for no other reason than to make themselves look bigger than they are so that they could get a higher multiple. Yep. I saw one was so distinct. One was like a robo slash, just a really, low end offering. The other was a high net worth, and somehow they were all one, and I had to be able to see through all of that. And I'm like, where are you? How long have you, a year now? But no systems talk to each other. Yeah, I've seen firms that have come to market that have purchased a bunch of small, 80, 90, $100 million AUM firms, and then not integrated them, but come to market as a single unified,
Right. Just trying to get the higher multiple because they're bigger,
Yeah, you've seen you've seen enough of these deals, but dollars will be paid for well-run companies. That will be, and the others, there's a market for it. Someone's going to buy that small deal and not really know what they're buying, which is fine too, right?
Yeah. And I also think like you have the benefit of not only studying, but I have actually been involved in, other industries where they've matured and there've been consolidation and roll-ups and that kind of stuff. And despite the fact that we've come, a hugely long way over the last 5 or 10 years. I remember, probably a dozen years ago, you could barely find lending capital in the space, forget any private equity or, capital partners. So that it's come a long, long way. We're still in terms of the full maturation of an industry, we're still pretty early.
Way young.
Yeah.
Way young. Yeah.
So,
like maybe second inning.
Yeah.
Way young. And quite frankly, firms like myself and a few others are getting very, very good at pricing these deals and recognizing, what's good or bad just right out the gate. Like, I'm not even going to waste any time bidding on this or talking to these firms after, we get a sense of how they run their business. And but there's a marketplace for every firm out there, and there are so many small firms, so many with the average age, and half of them are going to just retire and not tell anyone, right? Which is an advisor's old trick. I just quit taking clients. I just service the ones I have, and I'll play it forever.
And listen, in a way, a lot of people have judgment on that, but in a way, that's one of the beautiful things about this industry, right? You can, you can make a very nice living and run out the string and die with your boots on, so to speak. And
that's right.
And I'm a guy who looks at the enterprise value and says, "Wow, why wouldn't you monetize that?" But the fact that you have both of those options and can do very, very well in this space is a beautiful thing in a way.
Well, when we talk about monetizing, so, the first few deals I did, they made as much or more money in the recapitalization as they did actually on the first payment.
Right.
And so, people are like, why should I sell now if my firm's going to be worth more? And I'm like, because we got stock here and my firm is growing. If yours is growing at 10 and we're growing at 30, or 35, right? Are they not? Is it my number better than yours?
Right, and it's on both ends, right? First of all, the growth rate, and second of all, the arbitrage on the multiple, because your multiple is going to be higher, right?
That's right, right. That's how obviously you make money is you have to you've got to. The three things we look at is culture first, and then do we believe in financial planning, and the investment management has got to be similar but not identical, and then the economics of the deal for both you and me. But then once we're there and we're all on the same team, it's any firm that's coming in and saying that the integration's easy and don't worry about it and it's seamless. That's not true.
Right.
I'm just telling you, it is. There's a lot of moving parts. That's why I have a team that's dedicated to that. But it's not easy. It's not easy. And you and your employees are going to have to learn new processes, which you may or may not think that are good or bad. But I, as I say to my partners, we have a partner forum. If you think we could do something better, don't be selfish. Share it.
Right.
But yeah, this will continue for a long, long time. We've got a ton of runway in front of us.
So, Pat, before I ask you my final question on the podcast, is there anything else you want the audience, the potential targets, to know about you and Allworth and the team?
Well, not Allworth. I will tell you, when I talk to firms that are not ready to sell, this is what I always say to them. I said, look, I've been in the same business that you have for many, many years. I always take appointments and meetings with firms that I respect, be it larger or smaller than mine. I have met with more national firms before I took capital and have copied. In fact, if you're stealing from me, you're stealing twice because I took it from someone else. So I would just encourage you just to, don't take every meeting, but if you get to sit down with the chief operating officer or chief technology officer of a firm you respect, take the meeting. It's a Zoom meeting. It's an hour. You're going to learn something from it. Oh, and by the way, you may decide that you're better off joining them. Obviously, that's our motivation. The other thing is when firms aren't ready to sell, or I will actually tell them what I believe would make their firm more valuable.
Mm.
right? And the things that make firms more valuable is don't get too esoteric. Don't, babysit your own, write and babysit your own software. Firms are not buying software companies, they're buying investment advisory firms. Don't use like some esoteric financial planning software or some CRM that no one's ever heard of. Or don't, this market timing thing that if it's not broadly accepted by the industry and you think it's your claim to fame, you're going to stay independent for a long, long time.
Right. Great advice. Great advice. So Pat, my final question on the podcast is always about my highest value, my highest ideal in life, which is freedom. And for me, that means everything from freedom from all people around the world from oppression to why I haven't had a boss in decades and I'm an entrepreneur. What does freedom mean to you and how does it impact your life and business?
It's freedom to choose who I work with and what I do and how I serve. It's obviously God bless us. We've been born in the United States. I was just in Kenya and Rwanda, and Rwanda, they have a president, but the guy's been in office for 27 plus years. Don't quote me on it, but is that real? I don't know. Guessing not. What I like to talk to people, and I have 4 children that recently entered the workforce. I said, if I could get to the Venn diagram of what I'm passionate about, what I'm good at, and what the market will pay for, and I can find that little intersection in there, then that's where I want to live. Life is not follow your dreams, because if I was following my dream, I would ride my bike for a living, but I'm not good at it.
Right. Right.
But it's
You're not
a
going to be
dream.
in Tour de France anytime soon.
Not even. I can't even ride with people that are fast. Anyway, that's what freedom is, and we are in a great industry. I mean, it is. And never forget, at the end of the day, we get paid to serve others. We can sit in a room and talk about how we run our business, but at the end of the day, the clients are the ones that decide whether they use us or not, and that's where it begins and ends.
Love it.
So,
Pat McClain, thanks for being such a great guest on the DealQuest podcast.
all right, thanks, Corey. Best of luck to you.